What if I told you that right now, in the middle of an AI gold rush, two companies are making bets so radically different from each other that only one of them can actually survive to collect the reward? And what if the company everyone assumed was going to win is actually the one walking the most dangerous tightrope? Welcome back to Smart Stock Sam, the channel where we cut through the noise, skip the hype, and give you the numbers that actually move your portfolio. Today, we are cracking open one of the most explosive earnings matchups in the entire AI infrastructure space. We are talking about a former Bitcoin miner desperately trying to reinvent itself before its old business bleeds out completely, and a debt-fueled AI titan that is spending money so fast, its accountants are probably losing sleep. This is IREN versus CoreWeave. The earnings are fresh off the press, the moves in the market have been violent, and before this video is over, you will know exactly which of these two companies has the balance sheet to actually survive the race, and which one might be building on quicksand. Let's get into it. But first, you need to understand why the entire landscape for AI infrastructure investing just shifted under everyone's feet. For the past 2 years, the market had one very simple playbook: reward potential. If your company whispered the words AI capacity in an earnings call, your stock went to the moon. Bookings worth fractions of $1 million were somehow justifying billion-dollar valuations. But that era is officially over. The new imperative is brutal: prove the unit economics of scaling. Right now, serious institutional investors are laser-focused on 3 things. First, margin protection, and we want to see that staying above the 67% threshold. Second, backlog to revenue conversion pace. How fast can you actually turn a signed contract into real cash? And third, financing stability. It is no longer enough to have a cool AI story. You have to prove you can survive the cost of building it. The rules of the game have changed, and the companies that do not adapt will be left behind. But before we look at who is adapting, you need to hear about the invisible force quietly eating into the profits of even the most successful AI firms right now. Nobody is talking about the margin squeeze, and that is exactly why you need to hear about it here. While every financial headline is screaming about the AI boom, component prices for the Nvidia A100s and H100s are quietly but consistently rising, putting massive upward pressure on 2026 capital expenditure forecasts across the entire sector. If you are scaling AI infrastructure right now, you are in a race against inflation itself, and that race does not get easier as time goes on. The only way to survive is through real GPU pricing power. If you are stuck with older generation chips and you cannot command a premium from your customers, your margins will evaporate. And once margins go, the entire investment thesis unravels fast. This is not a hypothetical risk. It is happening right now, and it is exactly what makes the comparison between IREN and CoreWeave so fascinating and so consequential for anyone holding either stock. Margin stability is now the single most critical metric for any long-term investor in this space. So how are our two companies actually handling this pressure? As it turns out, they have chosen 2 completely different paths, and the contrast between them could not be more striking. In one corner, IREN Limited, the pivot and potential play. They started as a Bitcoin miner and are executing one of the most aggressive business transformations in the sector, leveraging an existing power pipeline and strategic partnerships to carve out a new life in AI infrastructure. In the other corner, CoreWeave, the leveraged Neocloud, a pure-play AI leader whose strategy is simple but extraordinarily risky. Use aggressive, debt-fueled capital expenditure to capture early market share and build a monumental backlog before the competition wakes up. One company is trying to bridge 2 worlds before one of them collapses. The other is trying to own the new world entirely, betting billions it can outrun its own costs. Let us start with the underdog story that just received the most powerful seal of approval in the technology industry. If you want to see what extreme volatility actually looks like in real time, look at IREN's chart from May 7th. The stock was down nearly 7% in regular trading, and then exploded into a 27% surge after hours. What caused that violent reversal? Two words: strategic validation. IREN announced a $2.1 billion partnership with Nvidia, and that partnership notably gives Nvidia the right to purchase 30 million shares. Let that sink in. Nvidia, the company that manufactures the backbone of the entire AI revolution, looked at IREN and said, "We want in." On top of that, IREN secured a $3.4 billion cloud contract and recently acquired Nostrum Group in Spain, adding 490 megawatts of capacity. This is a company moving fast, but the raw financial numbers tell a more sobering story. Looking at IREN's Q3 fiscal 2026 results, the headline numbers are rough, no sugarcoating it. Revenue came in at $144.8 million, missing consensus by over 35%. Net loss hit $247.8 million, largely driven by a $140 million impairment charge on old Bitcoin hardware. That is the legacy business dragging the new one down in real time. But here is the twist. If you look at the operational picture instead of the headline numbers, the story completely flips. AI cloud revenue hit $33.6 million, nearly double last quarter. They also energized their 1.4 gigawatt Sweetwater substation right on schedule. A classic case of the old business dragging down the new one. But the new one is growing at a pace that would make most tech startups jealous. The single most important figure for any IREN investor right now is the $70 Nvidia warrant price. This is not a random number. It acts as a hard institutional floor on the valuation. It is Nvidia saying, in the most financially binding way possible, we believe this company is worth at least $70 per share. IREN is anchoring its future around $3.7 billion in annualized recurring revenue by end of 2026. But none of that happens unless they can translate their 5 gigawatt power pipeline into signed operational contracts fast enough to offset the accelerating decline in Bitcoin mining revenue. They are dragging a heavy anchor, old debt, old hardware, old business model, and they need that AI revenue to start pulling its weight before the anchor wins. So what does market sentiment look like right now? Technically, IREN is a momentum monster sitting in the 99th percentile. Short-term traders should be careful though. The 5-day moving average is flashing a sell. But for longer daily and weekly timeframes, it is a strong buy. Sentiment on social platforms is extremely bullish, but the options market is telling a more cautious story. Massive activity at the $50 and $70 strike prices, but also high put volume underneath. The smart money is excited, and they should be, given a 700% run over the last 12 months. But they are also buying insurance after that extraordinary run. Now, while IREN is playing the scrappy reinvention game, our next company is the undisputed heavyweight of the Neocloud sector, and even giants can stumble. CoreWeave had been the darling of the AI world, up 80% year-to-date coming into earnings. Then the report dropped, and the stock slipped 6 to 10% in extended trading. The culprit? Soft guidance. CoreWeave is targeting $2.45 to $2.6 billion in Q2 revenue, which trails what Wall Street was expecting. But the real sticker shock came from capital expenditure. They heavily raised their 2026 spending forecast to a staggering $31 to $35 billion. Here is a question worth sitting with. When a company is spending $35 billion while simultaneously posting losses, at what point does the spending start feeling less like investment and more like a desperate bet? But the top-line growth numbers are almost impossible to argue with. CoreWeave's Q1 2026 revenue hit $2.08 billion, up 112% year over year. Their backlog, $99.4 billion, nearly triple what it was 12 months ago. The demand signal here is extraordinary, but the bottom line is getting absolutely squeezed. Net loss widened to $740 million, and adjusted operating margin collapsed from $163 million last year to just $21 million today. That is a 1% margin. running essentially at break-even just to keep the GPUs spinning. They have reaffirmed a $30 billion annualized recurring revenue target for 2027, but right now they are walking a dangerously thin tightrope, and the debt picture makes that tightrope even narrower. Here is the number every CoreWeave investor needs on their wall. Projected interest expense for Q2 sits between $650 million and $730 million, driven by nearly $25 billion in total debt. Now set that against their adjusted operating income for the same period, a mere $30 to $90 million. Pause and really let that gap register. The company is paying out between $600 and $700 million per quarter just in interest obligations and generating barely a fraction of that in operating income. Short-term investors are watching this gap with genuine alarm. The entire CoreWeave investment thesis rests on a single management promise: margins will recover to low double digits by Q4 2026. If that inflection point arrives on schedule, the debt load becomes manageable, and the reward on the other side is enormous. If it does not, could margins somehow accelerate even faster than guided and send this stock screaming higher? The math says that path is extremely narrow. Management calls this the escape velocity moment. The pitch is compelling. CoreWeave is a leveraged infrastructure vehicle, and leverage, when it works spectacularly. Yes, the debt and capital expenditure burdens are rising right now, but if margin expansion accelerates in the second half of 2026 as guided, the company escapes the gravitational pull of its own liabilities, and the upside from that point is massive. The pace of backlog to revenue conversion is literally the only variable that matters here. Turn those $99 billion in signed contracts into cash faster than interest expense devours it, and they win big. Fail to hit that pace with any consistency? The downside is swift, and it is severe. Before the final comparison, let us see where insiders and the options market are actually positioned, because they often know things the headlines do not. Technically, CoreWeave looks oversold after the post-earnings drop, but it still holds a strong buy on the 200-day moving average. The longer-term institutional trend remains intact. However, options flow is heavily skewed toward puts, 108,000 puts versus 76,000 calls. That is substantial downside positioning, or at minimum, a large number of investors buying protection. We also saw insider selling. An EVP of product sold $2.4 million worth of shares on May 5th. Likely tax-related from vesting, but it is never a great look when the stock is already sliding on weak guidance. Note it and move on. Now let us put both companies side by side. Here is the full tale of the tape. IREN is the former miner, $13 billion backlog, strategic Nvidia partnership anchoring a valuation floor at $70 per share, $2.6 billion in cash, and GPU financing that reduces near-term capital strain. CoreWeave is the pure play, $99.4 billion backlog, but carrying $25 billion in total debt against razor-thin operating margins. One story is reinvention, leveraging existing infrastructure with one of the most powerful strategic partners on the planet behind it. The other is sheer scale, betting that the magnitude of their opportunity will overwhelm the weight of their liabilities. IREN is playing a measured strategic game. CoreWeave is going all in on a high-leverage thesis. Only one may have the balance sheet to still be standing when the dust settles. And now, an important note before we close. Nothing in this video constitutes financial advice or a recommendation to buy or sell any security. All content here is strictly for educational and informational purposes only. Stock investing involves substantial risk, including the possible loss of principal. Always conduct your own thorough due diligence and consult a qualified financial professional before making any investment decisions. Past performance is never indicative of future results. Capital is always at risk. For short-term traders, prepare for volatility on both sides, because neither of these stocks is going to move calmly. Watch IREN for a sell the news pullback. If it cannot hold after-hours gains through the regular session, the Nvidia hype may already be fully priced in at these levels. For CoreWeave, the technically oversold condition presents a potential dip-buying setup, but only if you genuinely believe in that second half 2026 margin expansion story, and you have the conviction to hold through the noise. For long-term investors, your key metric for IREN is operational contract signing. How fast does that power pipeline convert into signed revenue-generating agreements? Every new contract matters. For CoreWeave, watch the interest-to-income gap every single quarter without fail. That is the scoreboard that tells you whether the escape velocity thesis is actually working. And that is a wrap on today's breakdown. Here is the question I want you to answer in the comments right now. Which company do you think actually survives this race and comes out as the dominant AI infrastructure player? The scrappy former miner with Nvidia's full backing, or the debt-fueled giant betting everything on margin expansion in the back half of the year? Drop your conviction below. I read every comment and genuinely want to know where Smart Stock Sam viewers are placing their confidence. If this breakdown gave you real clarity, hit the like button right now. It takes 1 second, and it tells the algorithm that honest, deep financial analysis deserves a much wider audience. Not subscribed yet? Hit subscribe and turn on the notification bell so you never miss another breakdown like this one. And if you want to support independent financial content that always puts the viewer first, consider sending a super thanks right here on YouTube. It goes directly toward keeping these deep dives coming. Until next time, stay sharp, stay informed, and always know what you own.